Now, many people didn't see it coming, and I'm referring to the MPC cutting the MPR to 11%. And of course, you guys at the FDC also predicted that they will maintain status quo on the rate. So how did you receive the news?
Like you rightly said, it was unexpected. Most analysts were anticipating that status quo will be maintained. But what the CBN has done, basically, it has prioritized stimulating growth over ensuring price stability, both in terms of inflation and exchange rate. And what we've seen with the adjustment in the asymmetric corridor around the MPR is basically the range between the placement borrowing rates have been widened. And for banks, what it means, they might see some increase or be marginal in the net interest margins. But definitely, it's clear that the CBN stance is aligned with what the government is trying to pursue, which is in terms of trying to boost the agricultural sector, trying to ensure that food self-sufficiency is achieved in terms of food production. Because you see the Nigerian story import a lot of food items, so the government, especially the center, trying to push this matter of grow what you eat. And so what we've seen right now is that with what the CBN is doing with reduction in interest rates, with the fact the CBN has even told banks to increase their exposure to the agricultural sector from 4% to 10%. And even now the CBN is saying under its anchor borrower program that is going to split the risk of lending with farmers 50-50. Basically, what they're just trying to do is to try and boost yields, to increase local production, and that will reduce food imports. Right now, food inflation is around 16%, and that is the major driver of the basket. So with all this being done, we expect to see that at least the impact will be positive on food prices down the line.
And still talking about the impacts now, how do you think that investors and markets react to this?
Well, the thing is, what the CBN is saying, the message that is being passed across and the signal, you will see there's some conflicting signs. And for investors right now, that when you see conflicting policy signals, you tend to stay back and it creates a lot of uncertainty, and it dampens investor confidence. Take, for instance, even what is happening in the Forex market. On one hand, you are trying to boost Forex supply. On the other hand, you're increasing the administrative control. So it's sending a lot of signals for investors, and especially the time it's heightened global uncertainty. Even if an investor is looking into the Nigerian market, the fact when your rates are becoming more unattractive because the interest rate or the real returns on investments are being in negative territory, and the fact that you've cut your benchmark by 100 basis points further with inflation at 13.22%, you're pushing real returns further into negative territory. So definitely that would weigh investors. So there's the fact that there's a lot of ambiguity and confusion in terms of policy signals. So it's not a good signal to send to investors, especially at this, because again, this year you're trying to attract capital inflows because the external reserves today they're increasing, tomorrow they're depleting based on the information being published on CBN's website. But the fact that our major forex supply or source of forex, which is oil, we've seen a sharp decline in oil proceeds. So you need to generate as much revenue, as much reserves as possible. Another form of getting that from forex is from investors' funds, because remittances, which is another source, we know that is sharply declined because of high unemployment globally. So right now, it's not sending the right message. But then again, are prioritizing out at the cost of rising inflation and possibly exchange rate stability. So it'll be interesting to see how that plays out next couple of months, at least pending the next meeting holds in November.
Absolutely. We have our fingers crossed. But let's talk about oil prices now. Of course, the volatility there continues. And this means we saw Brent at about $1 a barrel. But apart from a decline in Chinese oil import, what factors are driving the market currently and its implications for Nigeria?
Well, for the oil market, it's predominantly weak demand, and even basically that same factor that is affecting practically almost all commodities. Despite the fact that we're seeing that countries are beginning to reopen, we're seeing this gradual pickup in recovery, it's still way below the supply surfeit we're seeing in the market right now. And for oil prices, we are seeing that for one, China is reducing its oil imports. Two, we know that Libya is set to reopen oil facilities. Its oil facilities have been shut since January due to attacks on its pipelines, due to high insecurity. And this is a country that was producing over 1 million barrels in 2019. Now, because of the shutdown in its production, as at August, it was producing about 100,000 barrels. And now, with the resumption, we're bringing into the market about 260,000 barrels. This is going at a time where your demand, the oil demand forecast is still faltering and still weak. So definitely, it's going to impact on the market, it's going to impact on prices, and it might even force other OPEC members and their allies to actually deepen their own output costs just in order to be able to support prices. And bear in mind, Libya is exempt from the output cut. So it's not going to be affected. It's definitely going to play suppress oil prices. And the most potent risk is the risk of the rising infection cases globally. And we're seeing that because if that continues, we're going to see countries reimpose a lockdown, and you would even see some countries impose a precision lockdown, wherein in certain cities have been locked, and the impact of that may be more severe than the first lockdown that we witnessed earlier, and that definitely would impact on the demand and would impact on price.
And where's Nigeria in all of these, especially in terms of revenue?
So for Nigeria, we know that at least the over 65% decline in government revenue has been largely due to the plunge in oil prices, because that is our mainstay. And we're seeing that even other commodities are not faring as well. So definitely for Nigeria, it's a double whammy. You're experiencing lower oil prices. You are being forced to comply with your quota and being forced to reduce your production. So definitely your revenues would decline. And fine, we're seeing like in the FAC disbursements that were shared in September, it inched up marginally to about 682 billion naira. But imagine if we had higher oil prices, we would be recording FAC allocations about 700, 800 billion, because we've seen an improvement in VAT collection. We've seen an increase in import and export duties. But meanwhile, the petroleum profit taxes are reducing, all because of what's happening in the market. So definitely, it's going to play a significant role for Nigeria. And even also in terms of our reserves, the reserves keep depleting, despite the fact that now, again, the CBN is even increasing its forex supply. It has its regular weekly forex sales to the BDC. So it's going to, the impact on Nigeria would be significant.
Perhaps talking about our diversification drive now, we've seen cocoa prices also bearish on limited demand from Asia and US. So what are the implications of this for Nigeria's export earnings, especially as the country is seeking to improve its non-oil revenue?
Well, it's significant because, like I mentioned earlier, as in right now, obviously the government has this diversification strategy in place, and you're looking at non-oil exports. Cocoa is about our second largest non-oil export. And what we're seeing right now, because of the weak demand, again, that is affecting cocoa, weak demand from the US, from Asian countries, and even Europe, which is the region that consumes the most chocolates. They are also recording an increase in infection cases, which is also affecting demand. So definitely we're seeing cocoa prices soften. And even the two largest global producers of cocoa, I'm talking about Ivory Coast and Ghana, they are also trying to put in place measures that would mitigate the impact of this weak demand on their farmers. So for instance, they've increased the farm gate price by about 21%. And the farm gate price of cocoa is the price at which cocoa is bought from the farmers. So they're just doing that basically to offset the impact and improve livelihoods of these farmers. Some would even term that this move is political, because these countries have the elections coming up. So Ivory Coast's election is next month, Ghana's one is in December. So they are doing this, and again, it's going to be short term. But for Nigeria, Nigeria is a price follower. So irrespective of what is even happening in our own cocoa production industry, well, it's not going to have that much of an impact. So for instance, now, we know that the rains have been delayed to around September, which is affecting harvest. And also because cocoa pods, they thrive in when there is sunshine. So because the rains have been delayed to now, we're seeing that there's not enough sunshine to dry the cocoa pods, and that has become a breeding ground for the black pod disease, which is affecting our output. So again, the double whammy situation, we're experiencing lower production, global prices are fluctuating. So it's really a dicey situation for the Nigerian fiscal revenue position, and we're going to see that continue at least for the rest of 2020, maybe even 2021.
But then we just hope that things get better. Well, let's talk about gold now. Of course, spot gold has slipped below $1,900 an ounce on stronger US dollar. But are there any implications for Nigeria as well?
Yes, so Nigeria has some gold deposits, especially in Zamfara, and we have gold reserves of about 200 million ounces. And we know that, that industry is largely artisanal and it's not as regulated. And so some of the challenges being faced in that, or being encountered in that industry, so you have smuggling. Nigeria has lost about $2 to $3 billion in the last, between 2012 and 2018, basically to smuggling. And the fact that because most of the gold producing states are predominantly in the north, so obviously insecurity has been a major issue. With that said, the government has put in place some measures basically just to develop that industry. So for instance, there's the Presidential Artisanal Gold Mining Development Initiative, which is basically targeted towards the mining, processing and refining of gold. And what the government is trying to achieve is, okay, fine, as we mine this gold, process and refine it, let's get to the point where we can start exporting it. And obviously, if you can start exporting gold, that would obviously boost your export revenue. That would also show up your external reserves, because you can also have gold as part, gold deposits as part of your external reserves. The government will be able to get even royalties from there. And with gold prices, fine, they've fallen below $1,900 an ounce. But gold is down now, but it's not out because of its safe haven appeal. It thrives in uncertainty. And there's a heightened uncertainty right now because of what's happening in the market. And again, being a commodity, it fluctuates. Next week now, there's going to be a slew of headlines that will be released, stimulus talks of about the U.S.-China tensions, even the U.S. election news that are going to be released. And all this would impact on the price of gold. And bear in mind, there's an inverse relationship between the U.S. dollar and the price of gold. So because the dollar has strengthened, that's why we're seeing a weaker price for gold right now. So if these news that are being released, these points and facts that are being released in subsequent weeks affect or dampen the price of the dollar, obviously we'll see a pickup in gold. So for instance, the Chicago Federal Reserve president has stated that there might be a possibility of an increase in interest rates earlier than anticipated. Now, if that happens, that would push the value of the dollar higher to strengthen the dollar. And begin based on the inverse relationship, it makes gold less competitive compared to interest-bearing investment. So for Nigeria, despite the fact that the industry is still underdeveloped, but now is the time to benefit from it. And even if, yes, by the time you put in place all these measures, the CBN has this gold buying program where it acts like an off-taker, basically to shield gold miners from price volatility. By the time you put all these things in place, the economy moves in cycles. Yes, we're experiencing uncertainty now, and prices are high. The recovery comes in, the price of gold may stabilize. But then again, in the time of uncertainty, when the price of gold increases and we have all these things in place in the gold industry, Nigeria stands to benefit from it.
Which is what we're all hoping for. Now,
yes.
The CBN has come up with a raft of new guidelines and investigation into forex activities. Is this actually helping to stabilize the naira, which we're seeing at about 465 to the dollar at the parallel markets, even as the CBN is sustaining its forex sale to the BDCs?
Well, it just speaks again to what I mentioned earlier, that what the message of the central bank and the signals, they are sort of like contradictory. Yes, the CBN has been consistent with its weekly sales to BDCs, and to an extent that has kept the parallel market rate around 465, even as at yesterday, towards the end of yesterday, it appreciated to about 470. So definitely we're still seeing that. And again, what is driving the parallel market rate is speculative and arbitrage activities. Meanwhile, if you look at the IEFX window, you will see that also the rate has been trading within a tight band of about 385 to 386, basically because it's being determined by market forces. So when there is increased demand, obviously the price is affected when there's supply. So what right now, like I mentioned earlier, investors, due to the policy ambiguity and the fact that even your interest rates are not attractive, they are not incentivized to bring in their funds, and definitely will continue to play a role in the direction of the exchange rate.
All right, where are we now in terms of commodities price movement?
For the domestic commodities right now, you are seeing that the carbohydrates, so the likes of rice, yam, basically, we're still seeing high prices, and even the ingredients being used, tomatoes, onions, we're still seeing high prices. And again, because of the delayed rain, so the delayed rains affected harvest, so we're not seeing, obviously the output and the yield will be affected. So that's what we're seeing right now. And as we shift towards the planting season, definitely prices are going to remain elevated at the moment.
Thank you, Damilola Akibami, Head of Research at the FDC. Thank you for coming on the program.
Thank you, BC.